Well, good day, traders. And one of the questions I've been fielding a lot recently from clients, certainly those on the daily fix email that I send out every day. And if you want to be part of that, just reach out. I'll be happy to add you to the distribution. But the question that we've been fielding quite a lot at the moment is the idea that we've had a nice snapback in risk assets and whether that can continue going into late January. I think certainly if you take a step back and have a look at the sharp deterioration in financial conditions that we saw between October until December, with oil prices really collapsing, equity markets around the world showing strong drawdown and implied volatilities kicking up, high yield credit spreads really widening quite substantially relative to investment grade and risk-free rates. We got to a point where extreme pessimism had been priced into markets. I mean, we could see that the implied probability of a March cut had got to around 15–16%, and that never was going to happen. The Fed were never going to cut rates. So we knew that the markets had just priced in way too much on the extreme pessimism side. We just needed some good news, and we were going to see a snap back. And that good news came obviously from Jerome Powell. Now, Jerome Powell and the Federal Reserve and the people that we're seeing so far from the Federal Reserve is that we now have a Fed put firmly entrenched into financial markets. And the idea that the worse this gets, the worse, the more likely they're going to hold off, and also undo a lot of what they saw from the Fed meeting in December, and that is around what's happening with the balance sheet, where they said that the balance sheet was an autopilot. Jerome Powell's acknowledged the message that the market's giving us, which of course is one of concern for 2019, 2020, and effectively said if that message actually looks like it's going to play out, which is not our base case, but let's say it does, then of course we'll revisit what we're going to do with the balance sheet. So our view around the balance sheet is one of flexibility, but also, should it be necessarily, we'll hold off from raising the Fed funds rate for a protracted period of time. And of course, in that situation, we there have a put firmly entrenched into markets, and risk assets like that situation. We've seen a couple of data points, of course, which suggest that things aren't as bad as what was expected, certainly in the US. I still think that things in Europe look pretty terrible. I think things in China look pretty terrible. In Australia, there's obviously concerns around the housing markets and credit, which still need to play out, and that could be an impact for the RBA longer term. But in terms of the US, I think we've probably priced in a little bit too much on the pessimistic side. I think on the other side that we really have to focus on is the oil market, and it's right at the heart of everything we're seeing at the moment. We've seen a really nice move off $42, which was the June lows. We've pushed back about 18–19%, and we're now testing what was effectively a trading range between November and December, where we're trading sort of $55 down into $50. We're testing those lower echelons of that range at the moment. So we wanted to see how price reacts around that. If we get a break back into that former trading range, I think we could probably push back into $55. We've seen a re-rating in terms of inflation expectations. If you look at 5-year break-even rates, they've moved up about 20 basis points in the last couple of days alone, and that's seen real treasury rates actually coming under pressure. And I think that's a real big positive as well. If real yields can stay low and actually pull lower from here as inflation expectations move higher than nominal bond yields, again, that's another big situation for markets. Risk markets will like that situation. It's no surprise that we are seeing in this environment small caps really outperforming large caps. Energy stocks obviously working really, really well, especially here in Australia, best performing sector by far in 2019. But certainly in the US, the Russell has been the market that you want to be long, and the bulls will take that every day of the week that we're seeing that situation. But we are approaching a point in the Russell now, around 1460, 1470, where traders may look at adding extra supply into the market, looking to fade that strength through. So I'll be looking very closely at what happens in small caps if we can push up into those levels as well. I want to have a look at the VIX because we want to see whether or not we can sustain a move below 20%. I think that would be very positive. I think you're going to see a lot of volatility targeting funds, add exposures towards equity should the VIX pull back or the implied volatility in the S&P pull back in that situation. So we're looking at oil, we're looking at volatility. I want to also have a look at the US dollar because we've had a nice move up into the 61.8% retracement of the 2017 sell-off. We've been sort of consolidating for a few weeks around that level, but it looks like we've broken to the downside. Again, that's a make or break situation. It's very difficult to be long or be short the dollar index with any kind of conviction, knowing that the euro makes up 57% of that dollar basket. And if you look at the European economy, it looks pretty woeful at the moment. Germany, every data point we're seeing at the moment seems pretty woeful. The industrial production numbers we saw last night dropped nearly 5%, one of the biggest drops we've seen since 2016. IFO numbers are awful. There's a good chance now, probably above 50% chance, that when they come out with their GDP numbers, in mid-February that they actually could go into a technical recession. France obviously has big headwinds from the yellow vest protest. Italy, you're going to see very, very low growth, if not negative growth coming through there in 2019. So it's very difficult to be long euros, at least from a relative economic perspective in this environment. So we are watching the US dollar and whether or not we can see further downside in that situation. Again, it's a bit of a contrarian trade that we are going to see dollar weakness through 2019, and that concerns me a little bit in that situation. I am looking to sell rallies in dollar yen, and that probably leads me to believe that there's modest upside left in this risk asset rally. And I think the Mac Daddy of this situation remains about global growth. Now, there is a better feel towards the Xi-Trump-China-US trade-off at the moment. And, I think there probably will be a positive resolution. How much of that is now discounted into markets? I think there's probably some further juice in the equity markets around the world, because I think there probably will be a positive resolution down the line. We have seen Trump this morning coming out and suggesting that he wants to see a positive resolution because of the impact that will have on markets. So effectively, you've got a Powell put and you've got a Trump put into risk assets, which is giving them a bit of a floor in the moment. But I think once we've got that into the market, we will again focus on what's happening in global growth. Europe, China, the US, Australia. How much? What's the deterioration in growth as we get the rest of the data for December and into January, those numbers as well. But of course, I think in the short term, we're watching the dollar, we're watching euro dollar, and whether what happens with that currency cross, and of course what happens in the oil price as well, and what that means for inflation expectations, bond yields, real rates, and of course equity markets in that situation. Still plenty to trade for. I think if you're looking over the next 24 hours, we're going to be looking at the Fed minutes. I think they're probably largely redundant, given there's so much news that we've had since in the last 2 weeks, and what we've seen from Jerome Powell's individual speech and other Fed members as well. We've got the inventory numbers tonight around 2 o'clock on the oil numbers there. The market's looking for a decent drawdown. Of course, we're looking at what's happening in Saudi. They've been mostly the big supporters of the oil price in terms of those lower exports. And of course, I think in that situation, we're looking at what happens in implied volatilities as well.